Joining us now with her investor playbook for 2024, Saira Malik, Nuveen's Chief Investment Officer. Sarah, welcome. So the consumer keeps spending, maybe not at Macy's, based on what they're doing over there, but what does that signal about how the market is positioned and expectations for rate cuts?
Well, hey, John, good to see you. I'd say don't bet against the U.S. consumer. We saw that with retail sales yesterday, very strong holiday season. Consumers keep spending, and that's what is keeping this economy chugging along. But there are three issues that caused the markets to stumble out of the gates as we entered this year. That's geopolitics, Fed commentary, and inflationary data. Geopolitics are causing uncertainty for the markets. Fed commentary, the Fed speakers are walking a fine line to push back on some of the 6 rate cuts that are priced into the markets. We don't think we will see 6 rate cuts this year. And then, of course, inflationary data. Because of all that consumer spending, we saw CPI come in hotter than expected. We entered this year with S&P valuations about 20% higher than where they've been on average since 2010. And that's a tough place for the markets to start, given all this uncertainty.
And given that, it sounds like you're saying you expect rates to stay relatively higher for a relatively longer period of time, and that's going to slow down economic activity. And so investors should tweak their portfolios how?
Well, first of all, exactly on economic activity, you're seeing that with the Empire State Manufacturing data and ISM, which has been weaker. So we're moving to more of a defensive positioning. You even saw that today with tech stocks that tend to be a little bit more defensive. We think they'll be the key driver to earnings growth year over year. But other areas such as infrastructure, this is a very resilient sector during economic slowdowns because it's components or waste management and utilities, which tend to be acyclical. Also, dividend growers, companies that focus on growing their dividend over time, give investors income, and these companies have strong balance sheets and free cash flow, which also make them more stable during an economic slowdown.
In a way, though, flying in the face of this, and I know it's not a blanket statement that applies to everything. We're just talking about Supermicro taking up its guidance in a way that the stock is up 6+% after hours. And this is one of those high flyers trading, above $300 a share. It's, a year ago, it was down in the 100 level because of this AI stuff. So how should investors position themselves to either take advantage or continue to take advantage of that important trend?
Well, technology stocks, I think you need to be selective. Make sure that you differentiate between the ones that are cyclical with, for example, heavy advertising exposure, and the ones that have real tailwinds, which artificial intelligence is one of those. We think that will continue. It's not just hype. These tech companies, if you look at the earnings leaderboard, I think they will be the leaders with earnings growth year over year and eventually take fourth quarter earnings to year over year growth. We like software companies, which are more resilient during an economic slowdown. Companies like Microsoft and NVIDIA, with their head start in the artificial intelligence segment, I think they'll continue to win because they're so far ahead as it is.
What about consumer staples? They haven't been doing great.
Yeah, they struggled last year because of the diet drugs. If we go into a very deep recession and people become very defensive, I think that's when consumer staples tend to work. They have been underperformers, but I think they're still in a challenge position right now. They're not our top pick of a sector. We like areas that either can continue to grow during a recession, or even REITs, which tend to do well not only during periods of rate cuts, but during periods of rate pauses. They'd underperformed for the last couple of years because of the commercial real estate issues. But if you look at a REIT benchmark, commercial real estate is less than 5% of that benchmark.
Yeah, important to keep in mind. Finally, what about travel-related stocks? And I would put transports in with those. We've seen what's happened with Boeing, but people were very excited about travel for quite a while.
Yeah, and everyone's been expecting the consumer to roll over, and that would be negative for travel stocks, but we just haven't seen that yet. The consumer has continued to spend during this higher interest rate and inflationary period. I think much of that is due to the stimulus that was given to the consumer during the pandemic and the era of very low rates that we just had, in the decade before, which of course seems like such a long time ago at this point. So if the consumer keeps spending, I think that's good for travel stocks. But we are becoming increasingly cautious on the consumer. Over 20% interest rates on credit cards. We're seeing higher delinquencies in consumer credit card and auto debt. And so I am becoming concerned that eventually the consumer will run out of steam.